Good morning, everybody. Kirk Spano. It is December 16th, 2024. 9 days before I get my Christmas presents. Woo-hoo! Not really sure what I'm getting this year. I see a couple little boxes underneath the tree. All right. So on Wednesday night, I am going to be doing my 2025 outlook, and I think you will want to see that live. But if you don't, I will actually be putting it up on YouTube so you can watch it at your leisure. Why don't we take a look at what's going on today? President Trump is indeed inheriting a very strong U.S. economy. I know that people during the political season wanted to say about how we were in a recession and this was bad and that was bad, but the reality is that everything's pretty good. And if we want to keep it pretty good, we probably don't need any shock therapy. So we will find out if President Trump manages to the rhetoric, if he governs to the rhetoric and to those on the far extreme edges of his administration, or if he governs to a legacy, which we have learned over centuries is more centrist in nature. We'll find out. I do believe that we probably see at least one or two shocks to the system in the next few years, but ultimately, because the government, and this is the short story, the government requires lower interest rates in order to be able to service its debt, we will ultimately come out of this with lower interest rates. The neutral rate appears to be somewhere in the threes, between 3 and 4% on the Fed funds rate, and 5-year U.S. Treasury, which again, I say over and over again for the new folks, 5-year U.S. Treasuries are instrumental in construction and business development. Most loans that businesses get, most loans or notes that companies take or builders take to be able to build something are 5-year notes. There are no 30-year mortgages on a skyscraper or an office building. They are generally 5-year notes, sometimes 10, not often. About 90% of them are 5-year notes. So your building loan and then your first note that covers about the first 6 or 7 years of the existence of a new project needs to be about 5% or lower to get the internal rate of return you need in order to entice investors to invest. Also, having lower interest rates gets people out of money market accounts. And we have talked about how money market funds have surged in 2024, and especially since the election. So there are a lot of people expecting jitterbugs in the charts, causing opportunities to buy at lower prices. We'll see. But for right now, we are getting a very fast growing economy. Inflation is lower, below the 3%, which I said it would be by the end of this year. And it seems that the chant about inflation stays strong, which it usually is, just as it is usually wrong. Over the last 45 years now, we have had exactly 6 years where inflation was above 3%. So this idea that inflation is the boogeyman continues to be wrong in the face of deflationary and disinflationary forces. Demographics are outright deflationary. Technology is disinflationary. And that means that we need to be aware that the giant tidal wave that's coming at us right now is deflationary and disinflationary. The only things that are inflationary are policy. And you have heard the term counter-cyclical policy, which is when the government tightens or loosens, the Federal Reserve and the central banks tighten or loosen in order to move the economy in the direction it needs to move based on it getting to an extreme low or an extreme high. At extreme highs, the government tightens to bring it down a little bit, cool it off, get rid of inflationary pulses. But most of the time, we are trying to inflate, and this has been true since the financial crisis and the Great Recession. We've been trying to inflate in the face of those deflationary and disinflationary forces that will be with us for about the next 20 to 30 years until the tail end of the baby boomer generation is leaving us and crossing the Rainbow Bridge. Right, because everybody wants to be with their dog again. So we'll see what the shocks to the system, as they may or may not be in the next few years, what they do. Last year, I predicted that the S&P 500 would be up over 20% this year. I had the second highest projection on Seeking Alpha. People said I was nuts. I also said that Bitcoin would get to 100,000 this year, and it has. I said that as I was increasing my projection on Bitcoin to at least 300,000 by about 2028, maybe 29. So while Wall Street had all these estimates for 2024, the average being 4861, and Yardeni Research, who I often cite, was at 5,400. Kirk Spano was at 5,720. Right now, the S&P 500 is a little bit over 6,000, which I said it would hit in the first quarter of 2025. So I was a little bit late on that one, I guess. I still see the S&P 500 rallying into the new year and in January, at least for a couple of weeks, and we'll see what happens after that. On the Stocks on Spaces show on X, I'm finally starting to call it X instead of Twitter X or X Twitter. I said last week on Thursday, I believe, it might have been Tuesday, the 2 days that you're likely to find me on Stocks on Spaces on X, I said to watch January. If January starts out with a rally, then it peters out to the end of the month, where January ends up being a flat month or even a little bit negative, that's a very bad sign for the rest of the year. If January ends up being up by more than, I believe it's 2%, I think is the benchmark. I would have to take a look at Stock Trader's Almanac again. But if January is up more than 2%, we could have another big year on our hand. I doubt that. If I had to guess, feet to the fire, gun to my head, if I had to make a prediction for 2025, I would say that the S&P 500 gets into the middle 6,000s, pulls all the way back to around 5,000, then rallies hard at the end of the year. If I just had to guess the shape of the curve. Regardless of the shape of the curve, I believe the S&P 500 will end up in about the same place as it started, plus or minus a few points. There are a lot of analysts out there now who are projecting the S&P 500 at 6,500. So a single-digit return next year. And to me, that's plausible. Here's the problem. Normally, analysts undershoot or overshoot by a lot. And you can see that they dramatically undershot this year. They are trying not to be bearish for next year. And that's a warning sign to me. It means that with money market rates going up and everybody playing defense, that I think there's probably a self-fulfilling prophecy here that we get at least some low double-digit correction at some point next year. And the question becomes, at that point, will there be an ABC down, or will it be a pause that refreshes? And I think the answer will be found in this thought. Will President Trump unleash American exceptionalism, which clearly has been pretty exceptional the last several years, or will he break it? I think there are reasons, particularly tied to energy and tariffs and deregulation, that could cause it to be broken. We'll see. There are a lot of things that I like about what's coming, but there are several things that scare the hell out of me because I've seen them before. So when people glom on to ideology and that turns into rhetoric that's extreme in nature, that glosses over risks and only wants to cheerlead the upside, that's usually bad news. In fact, almost every time. So I think it's very important that you consider the risks in 2025 and what your real risk tolerance is. For me, I'm holding on to my best ideas. I'm watching for spots where the market punishes my best ideas so that I can buy more. And I'll mention a stock in a little while that I'm buying more of today. Stock Trader's Almanac points out that pretty often there's a pullback in the stock market in the middle of December, and then it rallies again. And it seems like that pattern is going to play out. The other thing that plays into that is that the quadruple witching option futures expiration on Friday almost always is bullish for about the next month. So into the next options expiration, third Friday of next month. Whichever way we pivot on the January options expiration and the Fed meeting that's right there just after, will be instructive of what at least a big hunk of next year will look like. We'll talk more about that on Wednesday night. So make sure that you go to the chat and you sign up for the meeting on Wednesday because you do need to register. Take a look at a couple of stocks. Algonquin Power and Utilities Corp. For those of you who want to collect a dividend and you'd like something that probably doubles in the next few years, I think this is a laydown. I don't think you're going to blow the doors off the market with this. I think you probably beat the market by the dividend, which is about 5% right now. So if you are a retiree and you're looking for something that is relatively safer, that pays a fat income, has incredible financial backing, just did some transformative things, and probably roughly doubles in line with what private equity firms are generally looking for when they invest, then I think this is the one. It just completed a correction on the Elliott wave. The Wyckoff springs are hitting. If we take a look at the super trend, it looks like it is bottoming out. When we take a look at the linear regression, it looks like this is about to pivot back up. How can I tell? Because at the bottom here, these orange lines, these Wyckoff springs, when all of those signals start to point in the other direction, it usually means that the trend is about to reverse. Now, long and variable time lags certainly occur sometimes, but at $4.57 a share on a stock that is clearly worth more, I don't think that there's a lot of risk here anymore. They don't have any risk of bankruptcy. It's a regulated utility now. They sold off their shares of Atlantica, which closed last week, and they received $1.1 billion. What is this company? They are regulated utility now, and they are set up to be acquired. That's what they're set up for. So private equity came in and cleaned it up. This is what has happened. Deal closed the other day. They received $1.1 billion. They're about to see rate increases across the board, and this is what it's looking like now. They received 1.7, 1.8 billion selling the renewables, 1.1 billion selling Atlantica. Their debt ratings are starting to improve, and their earnings should probably double, give or take, based on the reduced debt load and the increased rates, which have already started. So again, take a look at this presentation, learn about the company, what they do. This is a classic case of private equity investing, taking over operational control largely, and doing a 3, 4, 5 year double to triple on their money. That's what private equity firms do. They have sold off non-core assets, and they have positioned the company to be a very attractive acquisition target. And given what we know about energy demand going up again, these guys are in a sweet spot and they're cheap. I would not be selling cash secured puts. I would just be buying the stock. Next, Pfizer, also getting the Wyckoff spring. The institutional fair value gap is way up here. So Pfizer is a potential double over the next several years. And I think there's something that could cause it to break out. What is that? They're very into AI. And one of my predictions for this year was that AI would cure something. Didn't quite get there. Came up with a lot of novel treatment. What is Pfizer focused on at this point? I believe Pfizer, and this is something that you can mark down, hit the minute mark. I think Pfizer is going to be instrumental in largely curing cancer. Not that they'll be able to prevent it. I don't know that the cancer vaccines, I don't know that we're going to see those anytime soon. Not to the effect where they completely change things, but the combination of mRNA, which they're a leader in, and protein science, and AI, and manipulation of the genetic code at this point, tells me that they are going to be able to very effectively treat cancer, reduce its incidence, and reduce its severity to the point where it'll be a lot like AIDS. Over the last 35, 40 years, we have seen AIDS treatment, which isn't cheap, become very, very good. They can suppress it to the point that it's hard to find in your body anymore. They can reduce the incidence of transmission and of occurrence and reduce the severity. I believe that cancer is on that path. And then in the next 4, 5, 6 years, you're going to see massive breakthroughs. Several of the big pharma are going to be leaders there. And I think there's a very focused reason, a very strategic reason why Pfizer is focused in that area. They can see that the breakthroughs are coming. A number of big shots in the industry have even said, expect AI to start curing diseases. And again, I think that depends on your definition of cure. I think it's more along the lines of dramatically reduce the incidence, the spread, the development, the severity, to the point where it's almost gone. Of course, you'll still need to keep taking your drugs and having follow-ups, which will put money into the pockets of Pfizer and several others. One of the things that I'm concerned about is that some of the policies of the Trump administration will sabotage what they're trying to do. They are going to do sweeping rollbacks of EV and battery charger support. Now, how sweeping? Are they really going to get rid of the $7,500 credit on EVs? I don't know. And here's why I don't know. I don't know that the senators are going to support this. I don't even know if the House is going to support this. Why? Because there is a lot of money in Republican districts who have benefited more than Democratic districts from the Inflation Reduction Act. So I'm not going to guess on what ends up happening here. But what I will say is if they only get rid of the windmills, which I think there's a pretty strong economic reason to do, and they focus that money on other things, which they have said they want to focus towards the defense industry instead, then I think we're in pretty good shape. If they actually get rid of the EV incentive and the battery charger incentives, then it becomes a technological and economic argument as to when the cost curves against ICE vehicles and fossil fuels cross. Those lines have gotten closer but have not crossed yet. I thought it would be 2026 and 2027. It looks more like 28 to 30 at this point, when an electric vehicle is almost the same price as a gasoline vehicle. When that happens, and it is a question of when, and it's already happened in China, then it's a no-brainer to buy an EV. Because why on earth wouldn't you rather have an EV, many of which will come with an extended range charger that's fueled by 2 or 3 gallons of gasoline, giving you an equivalent mileage way into the hundreds? It becomes a no-brainer to buy those vehicles if the sticker price is close, because your maintenance on an EV is about half or less than an ICE vehicle, internal combustion engine vehicle. So I think we're just seeing a delay here. But the chanting, the rhetoric, the foot stomping, the yelling, the screaming, the headlines, the narrative is that these industries are going to be killed. Far from it. Just a different wiggle in the line. Capital's already been spent. Research and development has already happened, is happening. Ford and GM are already making their plans. What is interesting is that if they get rid of the EV subsidy, here's what's going to happen. All the pure EV companies get hurt the most. It's good for GM and Ford. Why? Because then the EV competitors start to disappear. And you get companies like Lucid and Rivian, and whichever ones still have a little bit of traction, they get absorbed by the legacy car makers. Volkswagen, Ford, GM, they all end up owning those EV companies. Maybe they pay a little bit, maybe they buy them out of bankruptcy, and you end up having the Volkswagen Rivian SUV and the Ford Lucid. That's what's coming. So if they get rid of the EV subsidy, you will want to take a shot at Ford because they will be a winner. In the short term, though, they got a downgrade because of the quarterly outlooks and the one-yearism of most analysts. 2 months ago, I told you I was getting out. I got out ahead of time, and I'm targeting a chance to buy it again. So here's your trend over the last couple of years, basically a choppy range. Elliott Wave says it's going to overshoot to below $8 a share, and I would probably buy a lot of it at that point. And you don't want to try to be too perfect because you don't know when there's some deal or some announcement from somewhere in the world that ends up being very good for Ford, GM, and Volkswagen. And I mentioned those 3 companies specifically for specific reasons. So if you want to read up on the industry, read up on those 3. There's other good companies, legacy makers. But if Trump kills the pure EV industry, the companies that are only EV, by taking away their subsidy, they have to get absorbed into bigger companies. And Ford, in particular, has already gotten rid of almost all their sedans, right? They don't really have a sedan anymore. They have the Mach-E EV, and I do believe that smaller vehicles will just be pure EV. But the SUVs and the pickup trucks, you're going to get a lot of EREVs, extended range EVs. You know, it's an EV, but it's not hybrid. It's an EV, but it has a battery charger that's fueled by gasoline in the back of it, 2-3 gallons. You get rid of your range anxiety and reduce the cost of the vehicle, because now you only need 1/3 as much battery, reducing cost and weight. So target Ford down here. All right, let's screen for options. Right now, Ford is on a triple sell, so probably respect that. But what do we like to see for selling covered calls? Buy, buy, sell. So that either means sell the stock or sell covered calls or a little bit of both. Warner Brothers Discovery, about a month ago, I sold cash secured puts I made the comment, oh, I'm back in the Warner Brothers Discovery. I sold the January $9 puts for a little over 5%. Bless my heart. Why did I say bless my heart? Because that's a stock that's burned us before. But sure enough, zoom to the moon, kind of. Now it's broken out of this downtrend. Going to get a little correction, then probably start rising up. And my guess is that this downtrend starts to move sideways. You're going to have the opportunity, if you want, to trade options on this one pretty effectively every couple of months. Sell a cash secured put. If it gets put to you, let it rally and sell a covered call. If you noticed, Warner Brothers Discovery is doing a similar thing as Comcast, getting rid of some of their cable stations. It appears as that all those companies will end up in the same place at one time, at some time, all those channels, and probably get hooked up with a studio, and there will be consolidation. So we are starting to see the reorganization of streaming and studios and channels, and cable, pretty rapidly now. Paramount has their deal, which is moving slow, but still appears as if it will happen. Suddenly there's pressure on Alphabet to do some splitting up of the company. So we'll see if YouTube finally makes a strategic transaction, or Amazon makes another one, or Apple TV finally buys something. But I think you're starting to get the rationalization that I've thought was coming for years, but entrenched interests have prevented it. Entrenched interests being executives and other people, but mainly the executives. But we know that Warner Brothers Discovery, David Zaslav's contract, his newer contract, the updated contract, has a huge bonus, over $100 million for change of control of the company. So he's clearly going to be open to selling Warner Brothers Discovery. And he'll try to angle to be the president or CEO of the next one too, whoever they merge into, get his bonus and keep his job. Wouldn't that be sweet for him if he's still interested in working? But this Warner chart is, after this little correction, going to develop a new trend that's probably sideways to slightly up. And you probably have a chance to get it back up to here. I don't know if it'll quite get to 50, but I think this range here, 30-ish, has some potential. It depends, because Zaslav might not be as interested in seeing the share price high anymore. He just might want his $100 million from selling the company. Hence, a really good cash secured put selling strategy. So this first one I did, I'll have made 5% in about 2 months, a little over 5% in 2 months. Annualized return in the 30s. I think we actually calculated it at like 41%. And I think you're going to get several more of those. I don't know that I want to own Warner Brothers Discovery, because I do think there's potentially a cap on how high it can go because of the incentives to the executive. But every dip, I think, will be an easy cash secured put sale. So if you're into that, there you go. All right. Have we missed anything? Any questions, or should we just move on to the last thing? This is a article that Les posted. Good article. This first breakfast is the Palantir people talking about industrialization and what they see with their business. It's part of their hype machine, but it's good information. Would I buy Palantir on a correction? I would. I got out of it too early, but I also bought way before everybody else. So go ahead and read this. And back to this article on the EVs. Our battery company, the one that I was very, very slow to get into, and I did it through selling cash secured puts. Looks like my cash secured puts will get put to me in January, at least some of them. I have 2 different strike prices. So our battery company with operations in Malaysia, it just came online and is expanding. And they did the capital raise that we knew about that apparently surprised the market, is a stock that if I didn't have the cash secured puts sold on, I'd actually be buying that stock today. So if you're a subscriber and you know who I'm talking about, I think it's time to buy that stock, because every time that it has a correction like this, institutions and big buyers have come in. And remember, their batteries are starting to go into cell phones and other devices because they are 30 to 50% more efficient, and they run a lot cooler, and they're safer. And they have applications not only to EVs, but to industrial grade batteries. So the things that utilities and corporations will use, because solar ain't going away. Solar barely has any subsidies anymore compared to what used to be out there where you could sell the electricity back. So sure, there's a little bit of a subsidy to build it, but you can't sell your electricity back for any more than wholesale minus a fee. So below wholesale, you can sell it back to utilities for. And that is something that we talked about years ago. Utilities wanted it that way so they could control solar energy, which they know is probably the most efficient thing out there. It's absolutely the most efficient during daytime hours. With the batteries getting so cheap and so efficient, they're about one generation away from being no-brainer builds for the utility companies. So the combination of natural gas, which is abundant and doesn't require a lot of technology to clean, and solar is the future of the grid, at least in the next decade. Will nuclear take off at some point? Yeah, maybe. Who knows? Hasn't so far. Will we get fusion? Maybe in my lifetime. But for the next decade, natural gas and solar. That's energy. Somebody asks about a Metis. You never roll a call. So we had some long calls for January. Nope, they'll just expire. That's life. Will I buy more calls? That's the question. And the answer is probably yes. When you know that a company has a large short interest and a lot of catalysts that are in its favor, you just keep buying the calls. Because it doesn't matter if one or two of them go zero. If a different one goes up 6,000%, you're just looking for the home run. You can live with a couple strikeouts. Ask Earl Weaver. Thoughts about quantum computing. I've talked about this a number of times. We will never really have quantum computing, but we will have massive improvements in that direction. The thing is that it requires a lot of energy. So they're going to have to find a balance. Are computers 100 or 1,000 or 10,000 times faster enough? Probably. So they're going to have to balance energy needs with speed. But the thing is, if they go from current speed of computers and power of computers to 100 times more, which basically we know they are going to be able to do in the next several years, think about what that does for AI. 1,000 times. What does that do for AI? 10,000 times. What does that do for AI? Quantum is the taming of randomness, which can't be 100% tamed, right? If you watch Star Trek, any space show, just when they think they have it figured out, a new nasty thing happens. So we'll never totally have quantum computing, but we will move in that direction to the point where computing becomes way more powerful than it is now. And think about that. You think it's powerful now compared to what it was 20 years ago. In 20 years, it's not even going to be recognizable. We are going to get to the point this century where we're going to have a very hard time determining what's sentient and what's not sentient. We're almost there. There are a handful of quantum stocks that are probably worth trading. It is unknowable who the winners are going to be, but my money is on the same companies that have won already. I think Microsoft, Google, Hyundai Corporation, Amazon, right? So at CES 2020, I was talking about this with you. So 4 years ago, almost 5 years ago, I was talking about this. So in those 5 years, what they said was coming someday suddenly is in that window where you're probably thinking, oh, by the end of the decade, some major advances. And that plays into this. The AI is just getting so smart because of the computing. So the question is, where does the money actually get made? Is it the companies that create the technology or the companies that use it well? History has shown that it's usually the companies that use it well. All right, so I will see you on Wednesday night. Nice little chart book I'll have. We'll talk about the 2025 outlook. All right, everybody, have a good day.